What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to answer the question, should I put my rentals in an S corporation? So first, we'd ask, why use an S corporation for anything? If you listened to the episode last week, you'd have the answer to that. An S corporation helps you save on payroll taxes. It also avoids the double tax of the C corporation, but most people use an S corporation to save on payroll taxes. Rather than being a single member LLC, when an LLC taxes the partnership, they make the S election in order to save on payroll taxes and that dreaded word FICA. That's the dreaded F word. That's your Social Security and Medicare tax. As a business owner, you pay both the employer and employee portion, which comes to a total of 15.3%, which is on top of the income taxes you already pay at the federal and state level. So just as a refresher, the S corporation is a tax election that allows the net income of the business to escape payroll tax, and is only subject to ordinary taxes. But the trade-off is, remember, the owner needs to put themselves on payroll, pay a reasonable salary. So the salary portion of the pay is subject to those payroll taxes. So when you report your business on a Schedule C as a typical sole proprietor or a single member LLC, taxed like a sole proprietor, that entire net income is subject to Social Security and Medicare taxes, where the S corporation, you're going to take some portion of that net income after you make your S election, assign it to salary, still subject to those taxes, and then the rest is the net income that's passed through to you on a K-1, avoids those payroll taxes. That money can be taken out in the form of distributions. So again, only the W-2 for the owner is subject to the FICA taxes, Social Security and Medicare. So that was our refresher on S corporations. You could get a bit more into it from last week's episode. Now let's get back to our original question about holding real estate in an S corporation. Now, there are several reasons not to use an S corp for your rentals. First, there's no self-employment tax on rental income. That's one of the primary tax benefits to using an S corporation, which is now removed because your rental income is not subject to payroll taxes. Another reason is that assets owned by an S corporation do not receive a step up in basis when the owner dies. Whatever assets are owned in the S corporation, their basis remains the same when the owner dies. Now, the shares of the S corporation get a step up in basis, but those underlying assets don't. So if you turn around and sell those assets, you have to consider that you have to sell off the shares in the same tax year if you want to try to net any gains and losses. And if it gets a lot messier, it's doable. You can work around it, but it's messier, takes a lot more planning, and it's going to create larger bills when the time comes for your heirs. So those are two pretty straightforward reasons. Now, I would say the most important reason not to own rental properties in an S corporation is that getting the property out of the S corporation triggers a taxable event. Maybe you need to remove it for asset protection purposes or estate planning or some other reason. It doesn't really matter, but to remove the property, distribute it to the owner or owners, that is treated as a taxable sale of the asset at its current fair market value. This is the case even if you're simply transferring it to another entity that you own. So let's say you purchased $1 million property in your S corporation sometime in the past, and now you need to get it out for whatever reason, and it's appreciated to $1.5 million. So you've got this $500,000 appreciation. To remove the property, that's going to trigger a $500,000 capital gain. Plus, you're going to have any depreciation recapture for that depreciation you've taken during the time the S corporation's owned the asset. That's going to create a significant tax bill. And it's not like a traditional sale where you're at least getting some money that's going to pay the taxes. The tax are going to be some percentage of the sale, and generally you're going to end up with some proceeds from the sale, and you can use those to pay the tax. In this case, there is no proceeds because the sale wasn't an actual sale to a third party where you receive money in exchange. This is a deemed sale due to the distribution. So you're going to have to find a way to come up with cash to pay that tax bill. And this isn't an uncommon scenario. I've seen it happen a few times. So there's a reason why it always makes sense to speak with an experienced tax advisor to determine which entity structure is most appropriate and best for your rental business. Now, for most investors, it's generally going to be single member LLC if you're a sole owner, which is considered a disregarded entity. That LLC is providing asset protection, doesn't really do anything for taxes. Or if you have partners, then you're going to use a multi-member LLC. This taxes as a partnership. You don't want to use the S corporation. You don't want to use a C corporation either, because you run into that same scenario. If you're taking the property out of a C corporation, then it's going to be treated as a deemed sale. Now, if you already own real estate in an S corporation, it doesn't mean you need to panic. It's not the end of the world. Maybe you can ride it out as an S corporation and make sure your heirs know how to handle dealing with the property upon your passing, or your trustee if you have a everything owned by your revocable living trust. Or depending on your circumstances, maybe there's some other tax planning opportunities out there that you can work with this and that may help the situation a bit. But in essence, at the end of the day, you really generally do not want to own your real estate in an S corporation. Doesn't mean never. There are some very rare circumstances, very limited circumstances where it may make sense, but for 99.9% of people, keep your real estate in an LLC, not in any type of corporation, including an S corporation. So that about does it for today's episode on whether or not you should own real estate in an S corporation. I hope you found value in this episode. If so, please hit that like and subscribe button or leave us a 5-star review. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.